Hey everyone, welcome back to Corporate Decoder. Today, FSHPU just filed an 8K reporting a shareholder vote to extend their business combination deadline, and I am seeing a clear sign that they're burning through cash. Quick note, this is not financial advice, just my take on public filings for educational purposes. To raise a big decision here for shareholders regarding extending the life of this SPAC, and the costs associated with it are worth paying close attention to. Alright, let's break down what Flagship Acquisition Corporation has just reported. Essentially, they've held a shareholder meeting and got approval to push back the date they need to complete a merger or business combination. This is a pretty common move for SPACs, or special purpose acquisition companies, when they haven't found a target company to merge with before their initial deadline. The company itself is incorporated in the Cayman Islands, which is a standard practice for many of these financial vehicles. It is interesting to see the ticker symbol FSHPU, which represents units, each consisting of one ordinary share and one right. They also have FSHP for the ordinary shares and FSHPR for the rights themselves. These details are important because they tell us about the different pieces of ownership investors hold. This filing is all about extending the deadline. The shareholders voted to allow the company to extend the time to find a merger target up to 12 times, with each extension being 1 month, going from the 20th of June 2026 all the way to the 20th of June 2027. Now, how does this extension happen? It's not free. The sponsor, which is typically the management team or founders of the SPAC, has to put money into the company's trust account for each monthly extension. The amount is the lesser of $60,000 or $0.033 for every outstanding ordinary share sold in their initial public offering. This might sound small, but when you multiply $0.033 by millions of shares, it adds up quickly. This is a key indicator that the company is spending money to stay alive while it searches for a deal. This extension was officially approved by amending their governing documents, basically their articles of association. It's a formal step to make sure they have the legal right to keep operating beyond their original deadline. Let's dive into the actual voting results. There were over 5 million ordinary shares outstanding, and a significant portion, over 4.2 million, were present either in person or by proxy at the meeting. This shows good shareholder participation. The main event was the extension proposal. To get this approved, they needed at least a 2/3 majority vote, and they got it. Out of the votes cast, 299,375 were for the extension, and 126,7577 were against. This means the majority of shareholders are willing to give the company more time. There was also an adjournment proposal, which is basically a backup plan. It would have allowed them to postpone the meeting further if they didn't have enough votes for the extension. Since the extension proposal passed with flying colors, this adjournment proposal wasn't actually needed or presented. Now here is a critical piece of information that often gets overlooked with these extensions redemptions. In connection with these shareholder votes, a substantial number of shareholders, holding 1507257 ordinary shares, chose to redeem their shares. This means they cashed out their investment, taking their pro rata portion of the money held in the trust account. Think about this. When shareholders redeem their shares, it means they've lost confidence in the company finding a good deal, or they simply want their money back before it potentially gets tied up in a merger that might not pan out. For every share redeemed, there is cash leaving the trust account that could have been used for the merger or for ongoing operations. This directly impacts the amount of capital available for a future business combination. In this case, over 1.5 million shares were redeemed, which is a significant portion of the shares that were outstanding. Looking at the external context, we see that Flagship Acquisition Corporation is trading at a very low price, around $0.08. This is on the lower end of its 52-week range, which has been between $0.08 and $0.14. This low stock price, combined with the significant redemptions, strongly suggests that the market is not optimistic about the company's prospects for finding a successful merger target. The company also lists its exhibits. Exhibit 3.1 is the amendment to their founding documents, and Exhibit 10.1 is the amendment to the trust agreement outlining the terms of the extension and the sponsor's obligations. These are the legal documents proving the changes. From my perspective, this filing is a clear signal that Flagship Acquisition Corporation is struggling to execute its primary objective, finding and merging with a viable business. The fact that shareholders are redeeming their shares in large numbers is a major concern. It means less capital is available for any future deal, and it raises questions about whether the management team can actually identify and complete a transaction that will create value for the remaining shareholders. Historically, SPACs that go through multiple deadline extensions and experience high redemption rates often struggle to find a strong merger target, and the stock performance post-merger can be lackluster. For example, many SPACs that extended deadlines in similar situations saw their stock prices decline significantly after their initial SPAC targets were announced, or even experienced delisting if the deals fell through. It's a tough path to navigate, and the redemptions here are a big red flag. The risk I am watching is how much more capital will be drained through redemptions in the coming months. My biggest concern is that the remaining capital might not be enough to make an attractive deal happen, or that the deal itself will be with a fundamentally weaker company due to the limited options. What I am actually looking for is a clear sign of a strong, undervalued target that can justify the ongoing costs and the faith of the remaining shareholders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. You can also join our Discord, linked in the description.